Hi everybody, this is Lara with your end of the week video for US oil for the trading week ending Friday 12th of July. I'm expecting this bounce for oil may end very early next week within the target zone from 60.53 to 61.74. Price is now within that zone, but the structure is not quite complete. I expect for oil that the larger trend still most likely remains down and my final target remains at 10.72. I am going to publish a bullish alternate wave count after repeated requests. I do not have a lot of confidence in it because it is not supported by classic technical analysis. However, let's consider all possibilities. If we see a new high by any amount at any time frame above 66.59 at that stage, I would have some confidence in a bullish outlook for oil, and a target for a third wave to end would be at 89.80. Bearish wave count first, because for oil this has the most support from classic technical analysis, and then we'll look at a bullish wave count. The bearish wave count for oil sees a huge three-step back pattern incomplete. Here's the first step, X, the second step, third step incomplete. The structure is a double zigzag. The first zigzag in the double is labelled cycle wave W. The double is joined by a 3 in the opposite direction labelled X, and the second zigzag in the double is expected to now be unfolding, labelled subdividing 535 and labelled cycle wave Y. This is the preferred wave count in terms of Elliott Wave, as well as having more support from classic technical analysis, because in terms of Elliott Wave, this upward movement from this low to this high subdivides best and has the best look as a three-wave zigzag structure. Also because double zigzags are really common structures, particularly for second waves. Within the second zigzag, labelled cycle wave Y, if primary B continues any further, it may not move beyond the start of primary A. A new high by any amount at any time frame above this price point would fully and firmly invalidate a bearish outlook for oil. The target, yes, is quite low. It expects that primary wave C may reach 1.618, the length of primary A. The target would see cycle wave Y move reasonably below the end of cycle wave W, because the purpose of cycle Y, the second zigzag in a double, is to deepen a correction when the first zigzag does not move price deep enough. I have received some interesting criticism for my target here, given in a rather interesting tone. I recall also some interesting criticism up here when I was expecting a really strong fall in price. And that's exactly what happened. To try and expect that a market can't do something that you don't want to see it do is to be imposing your view of what you want to happen on the market. I am going to try and take a step back and take a very dispassionate and as objective as I can view of this market and just look at the data. Let's take a look now at the weekly chart level. We're going to look at the structure of cycle wave X. I think my weekly chart, this week I'm going to zoom out and show you the whole structure of cycle wave X. We're also going to look at this for both my bull and bear wave counts, the detail of it on a daily chart so you can see the different subdivisions. This movement has a really good fit and a really good look at higher time frames as a three-wave structure. Now, oil is a commodity and it will exhibit impulses that have quicker fourth waves than its counterparts second waves, but that tendency of commodities to do that is especially prevalent for third waves, not for X waves. And so here, to see cycle wave X looking like a three-wave structure at higher time frames has the best look. To see primary wave C within cycle wave X looking like a five-wave structure would have the most normal look for a C wave within an X wave. This movement subdivides best 5, 3, 5 with primary wave C extended 1, 2, 3, 4, 5. 2 is a double zigzag and it's very deep. 4 is a running contracting triangle and it's very shallow. There is perfect alternation and really good proportion here between 2 and 4. This gives the wave count a really good look. Primary wave Y should be expected to be a zigzag subdividing 5, 3, 5, and I'm expecting here cycle Y. Primary wave C should be a 5-wave structure, either an impulse or an ending diagonal. At this stage, it has a best fit and look as an impulse, and I'll expect it to be so unless and until overlapping suggests I need to consider and chart a diagonal. An impulse subdivides 1, 2, 3, 4, 5. 2 may not move beyond the start of 1. 2 should subdivide as a 3-wave structure, and at the weekly chart level should look like a pretty obvious 3. So far it does, and if it gets up there, it should find really strong resistance at the upper edge of this Elliott channel. Draw the channel from the start of A to the end of B, place a parallel copy on the end of A. If 2 does come up to touch this trend line, there would be a very high probability of price turning and moving quite strongly lower, reacting down from that trend line. On the way down, a new low by any amount at any time frame below this price point would add confidence to a bearish outlook for oil. At the daily chart level B, this point here, the only problem at this stage for this wave count is to have the best fit for the first 5 down. It sees the final 5th wave slightly truncated by 0.11. That reduces the probability of this wave count by a small amount, but the bullish wave count has a greater problem, which further reduces its probability. It also doesn't have quite as much support from classic technical analysis, and so for that reason, this is still my preferred wave count. The first 5 down may be complete here. A 3 up may be very near to completion. 5, 3, 5, minus C, 1, 2, 3, 4. The final 5th wave to move higher may come up to touch resistance at this trend line, sitting somewhere within this target zone. Draw an Elliott channel around intermediate 2. We're going to use this quite strongly next week. Draw it from the start of A to the end of B. Place a parallel copy on the end of A. If and when we see a full daily candlestick below and not touching this trend line, preferably with downward movement, not just sideways, that would add quite a lot of confidence that this bounce labelled intermediate 2 is over, and the next movement down for intermediate 3 would then be expected to be underway. When I know where intermediate 2 may have ended, I can then apply a Fibonacci ratio between intermediate waves 1 and 3 to calculate a target for intermediate 3. I cannot do that yet because I do not know where it may have begun. Suffice to say, intermediate 3 must meet a core Elliott wave rule stating it needs to move below intermediate wave 1 price territory, and it has to move far enough below that point to allow a subsequent correction for intermediate 4 to unfold and remain below intermediate 1 price territory. So there would be quite a long way down to go. The invalidation point is the same as the weekly chart level. The rule used here is the same. Intermediate 2 may not move beyond the start of 1 above the invalidation point. This is the detail of cycle wave X, seen as a zigzag, 5, 3, 5. This is how I'm seeing all of the little subdivisions at the daily chart level. It has a perfect fit and it has a pretty good look in terms of proportion. Intermediate 4, a running contracting triangle. Intermediate 2, a deep double zigzag. So I'm providing this chart and a similar detail chart for the bullish wave count for those Elliott wave geeks amongst you to look at them side by side, and the difference really is in the middle of the third wave. And here the third wave has the strongest momentum, and the middle of it corresponds pretty much with the strongest reading on the histogram within the middle of the third wave. And so this fits with MACD. This has a really good look. I think this is the best way to see this upward movement as a 3-wave zigzag, and that fits a bearish Elliott wave count. This is a new alternate. It is still possible that oil has found a low and is in a new bull market, and if your own personal analysis of the market supports a bullish outlook for oil, then this may be the Elliott Wave count you choose to use. It is not my preferred Elliott Wave count though. This is still seen in the same way, but I've moved it back up 1 degree. It's possible that Supercycle 2 could be a complete zigzag down here and may not be continuing lower as a double zigzag. If this is the end of the bear market for oil and a new bull market begins here, then the first upward movement must be seen as a 5-wave structure. I'm going to label it cycle wave 1. This could be a complete zigzag, labelled cycle 2. It's just below the 0.618 Fibonacci ratio of cycle 1. That's why I'm going to label it complete there. And cycle wave 3 may have begun there. I'm applying a common Fibonacci ratio to calculate a target for cycle 3. Cycle 3 will equal 1.618 times the length of cycle 1 at 116.79. Within cycle 3, which may only subdivide as an impulse, no second wave correction may move beyond its start below the invalidation point. And so that's why a new low by any amount at any time frame would firmly invalidate this alternate. I would again discard a bullish wave count for oil and have quite a lot of confidence in my bearish targets for oil. Let's take a look at this at the weekly chart level. We're going to have a cursory look at cycle wave 1 as a 5-wave impulse from here, this point here, 1, 2, 3, 4, 5. The difference between my 2-wave counts is in the middle of the 3rd wave. A cursory look says, well, this doesn't actually look that bad. And the problem really is within primary wave 3. There is disproportionate 4th and 2nd waves. But sometimes oil, typical of commodities, will exhibit disproportionate 2nd and 4th waves. The 4th wave can be remarkably brief and shallow, compared to the 2nd wave, which can be more time-consuming and deep. That's a tendency, typical of commodities, which particularly turns up in 5th wave positions. And so, if this is a 1st wave, we could have had that tendency show up here in the 3rd wave, so let's consider this possibility. Cycle wave 2 may have been over here, and at the weekly chart level, this downward movement does have a pretty good look as a 3-wave structure. So again, let's consider this possibility. It is possible in my analysis on the balance of evidence, the data we have in hand at the moment, it does not have as much support from classic technical analysis. Let's take a look at the daily chart level from the low of primary. Well, we're going to look at the high of primary 1 here, this point here. Primary wave 2 may subdivide best as a zigzag, 5, 3, 5. We've avoided the truncation, and now if we don't see a truncation and a 5 ending here, now we see an impulse unfolding upward. 1, 2, 3, 4, and 5 nearing completion. And so this is going to be a really important price point. For this wave count, intermediate 2, when it arrives, may not move beyond the start of 1. A new low by any amount at any time frame would see me discard this bullish wave count at all time frames. It would be extremely unlikely. The probability would be too low to publish. I'd have to rework seeing in primary wave 2 continuing lower. If this wave count unfolds as expected and price remains above this point, if there is weakness in the next downward movement, that could support this wave count, but at this stage it does not have support from classic technical analysis. But if your personal analysis of the data supports a more bullish outlook, you may want to consider using this Elliott wave count, which will provide you with targets and invalidation points. At the daily chart levels is the detail of primary wave 1, 1, 2, 3, 4, 5, and the difference is in the middle of the 3rd wave. We have to see it differently, so if you want to look at them side by side, and I've given you Fibonacci ratios also at primary and I think intermediate degree within primary 3. A little bit of a problem here in that intermediate 2 is more time consuming than primary 2 1 degree higher, but sometimes that's how it happens when impulses start out slowly. Primary wave 4 is more time consuming than primary wave 2. That's a slight problem also. But intermediate 4 is more brief than intermediate 2, but because this is happening within primary 3, a 3rd wave, That could follow a common tendency for oil, so let's consider this possibility. It doesn't have quite as good a fit in the middle of the third wave though. Let's have a look at the monthly chart level. The month of June was complete. It was a lower month with a lower low and a lower high. The balance of volume though was upward. Upward movement within the month, which closed green, did not have support from volume. The prior downward month, again a lower, lower, lower high, the candlestick was red, the balance of volume was down. Downward movement within the month of May did have support from volume, actively pushing price lower. At the monthly chart level, the short-term volume profile remains bearish. Look out for next support about 42. At this major high here, there was a strong bearish engulfing candlestick pattern and a bearish long upper wick. We were expecting more downward movement. Here, a bullish long lower wick. We were expecting some upward movement. It's coming overall with declining volume, ending with a bearish long upper wick, followed by a bearish engulfing candlestick pattern. This is a strong bearish candlestick reversal pattern. It has support from volume. This look here is bearish. It looks like the trend is down, a counter trend movement with lighter volume and declining ATR is a counter trend movement. Again, it looks like the trend may still be down. RSI is neutral. There is room for price to rise or fall. MACD is bearish, but it's above the zero line, not full ball bearish. The only thing on this chart which may support a bullish outlook for oil is there is bullish divergence between price and on-balance volume between these highs here. I wouldn't give that as much weight though. Sometimes that divergence can simply disappear, even between price and on-balance volume. I will always put more weight into how on-balance volume behaves with its trend lines than it does with divergence. But I will note, for those of you who have a bullish outlook, that does support a bullish outlook for oil at this time. Let's have a look at the weekly chart and make that a little bit bigger. Actually, let's close that. At the weekly chart level, this strong downward movement here has volume actively pushing price lower. We get a candlestick reversal pattern at the low, a morning doji star, and then we get upward movement where overall volume at the beginning particularly was declining. Toward the end here, there was some support from volume. At the end, much lighter volume. ATR strongly increasing as price is moving lower. As price moves higher, ATR declines. As price moves lower, ATR increases. As price moves higher for the last very few weeks, ATR now flattening off. When price is moving within the trend, ATR is increasing. The bears are able to push price lower further and further each week, actively pushing price lower, increasingly active as increasing volume shows. This is most likely the direction of the trend. This looks like a counter trend movement. This again looks most likely like the direction of a trend, and this a counter trend movement. At the low here, a candlestick reversal pattern telling us to expect an interruption or a trend change. Here, this week, prices closed not that close to the high, but it's a strong bullish candlestick. There is not support from volume, however. As price is rising, volume is declining, ATR is flattening off. This movement looks like a counter trend movement. However, it may not quite be done. There is no candlestick reversal pattern yet at the high. There is at this point no evidence that this bounce should be over. Look out for resistance, quite strong resistance just ahead, about 63 to 64. At this time frame, ATR is now declining, telling us that there is at this stage no clear trend. If it does begin to rise, Then we'll look at the positioning of the DX lines to tell us which direction the trend may be. On balance volume is at resistance. It's not particularly strong resistance though. It's only had 2 prior anchor points and it's not long held. A break above this yellow resistance line would be a weak bullish signal. RSI is neutral. There is still room for this bounce to continue before conditions reach extreme. Likewise, stochastics is neutral. At the daily chart level, this is the bounce in more detail. A bullish candlestick reversal pattern here just after the low. At this stage, there is no bearish candlestick reversal pattern to warn us that this bounce may be done. Next resistance close by at 61.8. There was a little bit of support from volume for this quite strong upward day as well. There is a little bit of room to move and there's a little bit of strength yet in this bounce. It doesn't look quite yet worn out. ADX is flat at the daily chart level. It's telling us that there is no clear trend. ATR has been flattening off and is now beginning to decline as this bounce continues, indicating that within the bounce there is some weakness. This again looks like a counter trend movement, and that supports a bearish Elliott Wave count. On balance volume at the daily chart level has this range. Look out for a break above resistance or below support to give a signal. The signal either way is not going to have strong technical significance though, because the trend lines containing this have quite a reasonable slope. There are 3 things that we look for trend lines to judge the technical significance: how long they are held, how many times they are tested, and how strong the slope is. The longer a trend line is held, the more significance it has. The more often times it's tested, the more significance it has. The shallower the slope, the more significance it has. These lines are reasonably long held, tested quite a few times, but the slope reduces the significance. However, that's the range that it's in at the moment. RSI is in neutral territory. At the daily chart level, there is still room for this bounce to continue. Stochastics is overbought, exhibits some bearish divergence that could simply disappear. Still, it could remain overbought for longer. It can remain overbought for quite a reasonable period of time before we see a turn. I am going to be looking out for a bearish candlestick reversal pattern before I expect that this bounce is done, or a breakout from on balance volume, or a new swing low below this prior low back here. If that happens, I will expect the bounce is done, and then I'll be looking for the new wave down to make new lows for oil below this prior point here. That's all from me this week with your oil analysis. I hope all our members are having an awesome weekend.